Welcome to Talk Tickers, the professional's earnings call and market event summarization podcast. Today, we are looking at a story that, well, it hasn't just moved the needle. It has fundamentally broken the gauge.
Completely shattered it, yeah.
We are witnessing a moment that I think historians might actually look back on as, the definitive end of one economic era.
And the violent birth of another.
Exactly.
Okay.
I mean, if you thought the last few years of monetary policy were volatile, you really, really need to reset your expectations.
Oh, completely.
The era of the PhD economist is officially over.
It's done.
The era of the market guy has returned, and the bond market is already voting with its feet.
It is a fascinating, and I would argue a somewhat terrifying week for anyone managing capital.
For sure.
We're breaking down the nomination of Kevin Warsh as the next chairman of the Federal Reserve. And I think we need to be very clear right off the bat.
Okay.
This isn't just a personnel change. This isn't just swapping one guy in a gray suit for another guy in a blue suit. This is it's a regime shift in monetary philosophy.
A regime shift. That's a strong phrase.
It is. We're moving from, the academic theory of the Bernanke, Yellen, Powell era to something much more visceral, much more market-driven, and frankly, much, much riskier.
Absolutely. The stakes here are incredibly high.
Right.
We aren't just talking about whether we get a 25 basis point cut or, a hold to the next meeting.
No, that's small ball now.
We are talking about the potential end of the Fed put, a looming constitutional crisis between the White House and the current chair, and a market repricing that has already
just in the last few days
cratered precious metals and sent bank stocks on a tear that it defies gravity.
The narrative has shifted completely. For 2 years, the only game in town was when will rates come down?
That was the only question.
Now the question is, how does the entire plumbing of the financial system change? And that's what we need to unpack today.
Right.
This isn't just about the price of money anymore. It's about the mechanics of how money actually moves through the system.
Okay, so let's get right into it. Headlines versus the reality.
Let's do it.
The announcement came on January 30th, 2026. President Trump officially nominated Kevin Warsh to replace Jerome Powell when his term expires in May.
Right.
Trump called him central casting, which, let's be honest, is a very specific type of compliment coming from him.
It is. It speaks to an aesthetic, a projection of power.
And he predicted Warsh would be one of the great Fed chairmen.
But the market, it didn't care about his jawline or his suit. The market cared about his history and his stated philosophy.
And the reaction was immediate.
The immediate reaction, which we're calling the Warsh shock, was violent. And I use that word carefully. It wasn't a drift. It was a repricing event.
Let's look at the scoreboard, because the divergence is just wild.
It's a tale of two markets.
Treasuries, you saw an immediate spike in yields. The curve is moving aggressively. But the real carnage, the place where fortunes were absolutely lost this week,
commodities,
was in commodities. Gold plummeted over 9%, trading down around, $4,903?
$49.03, yeah. Which is a huge move for gold. But silver.
And silver, oh my God, silver crashed nearly 30%.
That move in silver is historic. I mean, you do not see 30% drops in a major global commodity in a matter of days unless a foundational thesis has just been shattered.
So what's the thesis that got shattered?
It's the currency debasement trade. A drop of that magnitude tells you that the idea that the dollar is trash, that fiscal dominance is inevitable, and that you need hard assets to survive, that was being violently repriced.
So the market just said, nope, new sheriff in town.
The market looked at Warsh and said, wait a minute, the printing press might actually be getting turned off.
Okay, so that's the loser's bracket. On the flip side, you have the equities market, which was, as you said, a tale of two cities.
Completely.
The S&P 500 and the big high-growth tech names, your Apples, your Microsofts, they face pressure because obviously rising yields hurt growth stocks.
Standard playbook.
But the financials, JP Morgan, Goldman Sachs, they rallied hard.
And that divergence is the key. It's the key to understanding this entire deep dive. Why would banks rally when the rest of the market is nervous about yields?
Right. It seems counterintuitive.
It's because the market anticipates that Warsh is going to change the rules of the game specifically to favor the banks.
We also saw the U.S. dollar strengthen significantly.
Massively against a whole basket of currencies. And the global impact was immediate. The South Korean Kospi dropped over 5%.
Okay, so why the Kospi? Why did it take such a big hit?
It's all about dollar liquidity. South Korea, like a lot of emerging markets, is incredibly sensitive to the availability of U.S. dollars.
Okay.
So when the market gets even a sniff that the Fed might shrink its balance sheet, which effectively sucks dollars out of the global system, cash rushes back to the U.S. core.
So it's a flight to safety.
It's a flight to liquidity. Emerging markets get starved. The Kospi dropping 5% is the sound of global capital fleeing the periphery and running for the safety of the U.S. dollar, anticipating a scarcity of greenbacks.
So the headline is, Trump picks Warsh. But the real story is this violent repricing of liquidity expectations.
Exactly. It feels like the market is waking up from a long party with a massive hangover.
Yeah.
It's realizing that the Fed put that implicit safety net where the Fed always steps in to save the stock market at any sign of trouble might be gone, or at least it's being renegotiated. And Warsh has been very critical of that concept for a very long time.
Okay, before we get into the really complex mechanics of, privatized QE and the banking regulations, let's give the listener some background. Who is Kevin Warsh?
Right.
Because as you mentioned, he's not the typical academic we're used to seeing in this chair. He's not writing papers on the Phillips curve in some dusty office.
No, he is not. And that is his biggest asset and his biggest liability, depending on who you ask.
So what's the resume?
His resume is lawyer and investment banker. He was at Morgan Stanley, mergers and acquisitions. He does not have a PhD in economics.
Which, in the halls of the Fed, that's usually a prerequisite, right? It's almost like a guild requirement.
For the last few decades, yes, absolutely. We've had Janet Yellen, Ben Bernanke academics who spent their lives studying models. Warsh is a markets guy.
He does have Fed experience, though.
He does. He actually served as a governor from 2006 to 2011. He was the youngest appointment in history at just 35 years old.
35, wow.
But crucially, during the 2008 financial crisis, he wasn't running the models. He was the liaison to Wall Street. He was the guy on the phone with the trading desks at 3 a.m.
So he knows how the sausage is made.
He knows how the sausage is made, he knows the people making it, and he knows where all the bodies are buried.
He's connected.
He is deeply embedded in the smart money ecosystem. He's married to Jane Lauder, the Estee Lauder heir. He has deep ties to Stanley Druckenmiller and the Duquesne family office. This is a man who speaks the language of capital allocators, of hedge fund managers, not necessarily the language of theoretical econometrics.
And that distinction really matters because academics tend to care about the model fitting the data, whereas market guys care about price action and sentiment.
Precisely. An academic looks at a model and says, according to the Taylor rule, rates should be X. A market guy looks at the credit spreads and says, the plumbing is clogging up, we need to move now. Warsh operates on instinct and market feedback loops.
And that connection to the smart money explains some of the market reaction. But there is a very, very weird dynamic playing out with the timeline here.
Oh, this is where it gets really interesting.
Jerome Powell's chairmanship ends in May, but his term as a governor lasts until 2028. This is something I think a lot of people gloss over.
They do, and it could be the most important part of this whole story. It creates what we're calling a shadow chair risk.
A shadow chair?
Yeah. Historically, when a chair is replaced, they resign from the board of governors immediately. It's a courtesy to the new guy. You don't want the old boss sitting in the corner office second-guessing you.
Right. It's like the ex-CEO staying on the board and just glaring at you during meetings while passing notes to the other members. It's a nightmare.
Exactly. But the relationship between Trump and Powell is, well, it's toxic, to say the least.
That's putting it mildly.
So there is a very real scenario where Powell refuses to resign his governor's seat. He could just stay on the board until 2028.
And what would that mean?
You could have a situation where Warsh is the chair trying to implement this new regime, and Powell is sitting right there, potentially leading a dissent or acting as a powerful counterweight. We haven't seen a situation like that in 80 years.
That would be incredibly awkward. I mean, can you imagine the FOMC meetings? Warsh proposes a strategy, and Powell just slowly shakes his head from across the table.
It creates a rival power center. And remember, the chair is powerful, but they still need votes. If Powell stays and rallies, the other governors, who are mostly academics and might view Warsh with suspicion, Warsh could find himself isolated in his own boardroom.
That brings us to the core of what you call the Warsh pivot. You mentioned he's a markets guy, but historically he's been a hawk, right? He hates inflation. He's not an easy money guy.
He's a classic hawk, a textbook hawk. He resigned in 2011 specifically because he was critical of QE2 quantitative easing too.
Right.
He criticized what he called the pampered princes of the Fed and the bloated balance sheet. He has spent the last decade writing op-eds in the Wall Street Journal saying the Fed is doing too much, interfering too much, and distorting markets.
But wait, here's where it gets confusing for me. Trump wants lower rates. Trump loves cheap money. Trump wants the Dow at 50,000.
Right.
If Warsh is a hawk who hates printing money, why on earth did Trump pick him? And why is Warsh suddenly sounding dovish?
That is the multi-trillion-dollar question. This is the new Warsh. He has pivoted. He has aligned himself with the Trump administration's push for lower rates.
So he just changed his mind?
No, he has a very clever and intellectually coherent way of justifying it. He isn't just saying, I'm cutting rates to help the stock market.
So what's the rationale? How do you square I hate inflation with let's cut rates?
2 words, the magic of AI.
AI? Really? We're using AI to justify monetary policy now.
Yes. Warsh is making the case that the artificial intelligence boom is a massive structural disinflationary force.
Okay.
He argues that AI is going to increase productivity so much that we can afford to have lower interest rates without causing inflation. It's a classic supply-side argument.
Okay, let's unpack that supply-side idea. Usually the Fed raises rates to crush demand, make it too expensive to buy a house or a car so prices stop rising. Warsh is saying, what exactly?
He's saying we don't need to crush demand if supply explodes. If AI makes companies, say, 20% more efficient, they can produce more goods and services at a lower cost. If goods are cheaper to make, prices go down naturally. Therefore, you don't need high interest rates to fight inflation. The technology fights the inflation for you.
So it's a get-out-of-jail-free card for monetary policy.
It allows him to say to the bond vigilantes, I'm not being irresponsible by cutting rates. I'm simply recognizing this massive productivity boom.
That is convenient.
It is remarkably convenient. It aligns perfectly with the political demands of the White House. It allows him to say, I am still a hawk, I am still fiscally responsible, but the technology allows us to cut rates.
So he gets to have his cake and eat it too. He pleases Trump with cuts, but he keeps his sound money credentials by claiming it's a productivity play.
That's the narrative.
But there's a catch, isn't there? Because while he wants lower rates, he still hates a balance sheet. And this seems to be where the math gets really, really hard.
This is the core tension. This is the thing that investors have to understand. If you take nothing else away from this deep dive, take this. The regime change thesis is about the conflict between the price of money and the quantity of money.
Okay, price versus quantity.
Warsh wants lower interest rates, which is the price of money. That's dovish. But he wants a smaller balance sheet, which is the quantity of money. And that's hawkish.
Let's break that down. The Fed's balance sheet is currently around, what, $6.6 trillion?
Yeah, somewhere around there.
That's the amount of assets, mostly treasuries and mortgage-backed securities, that the Fed owns. Warsh thinks that number is obscene.
He thinks it distorts markets. He believes that when the central bank owns that much of the market, it breaks the price discovery mechanism. He wants to shrink it.
Right. And here's the mechanism that is freaking people out. If you shrink the balance sheet, you are selling bonds, or you are letting them roll off without replacing them. That drains liquidity from the system.
It sucks cash out of the economy.
And if you drain liquidity, usually yields go up.
Yeah.
So you have this huge conflict. He wants to cut the Fed funds rate, the short-term rate, but he wants to sell bonds, which pushes up long-term rates.
Which explains exactly why the yield curve is steepening. Short rates down, long rates up. The market is saying, okay, Warsh will cut the overnight rate, but if he dumps trillions of dollars of bonds onto the market, the 10-year and 30-year yields have to rise to attract buyers.
Okay, and this is the critical part.
Yeah.
If the Fed sells all these bonds to shrink the balance sheet,
Right.
who buys them?
Right.
Because the U.S. government is still running a massive deficit. They are printing treasuries like crazy. If the Fed isn't buying them and is actually selling them, who on earth steps in? If there are no buyers, yields spike to the moon and the economy crashes.
And that brings us to the most fascinating theory in this whole saga, the thing that explains the bank rally, the theory of privatized QE.
Privatized QE. Okay, that sounds like a buzzword, but let's treat this like a deep dive. What does it actually mean in practice? How do you privatize quantitative easing?
It's a bit of a misnomer, but the effect is the same. To understand it, we have to look at why banks aren't buying treasuries right now. After Silicon Valley Bank blew up in 2023, regulators, specifically Michael Barr, pushed for what they called the Basel III endgame.
This was the push for higher capital requirements, right? Making banks hold more equity against their assets so they don't fail when the wind blows.
Correct. And specifically, we need to talk about the supplementary leverage ratio, or SLR.
The SLR.
Right. Without getting too bogged down in the math, the SLR essentially penalizes banks for holding low-risk assets like treasuries. It treats a U.S. government bond almost the same as a risky corporate loan in terms of how much capital you have to lock up on your balance sheet to support it.
So the regulations literally made it capital inefficient for JP Morgan or Bank of America to step in and buy U.S. debt. It cost them money to hold safe assets.
Exactly. Completely clogged the plumbing. Warsh's thesis, and this is the genius or the danger, depending on your view, is to say the Fed needs to sell bonds to shrink our balance sheet. The Treasury needs to sell bonds to fund the deficit. Who has the money?
The banks.
The banks. But they can't buy because of the SLR.
Oh.
So Warsh cuts the SLR. He effectively says to Jamie Dimon, I will exempt U.S. Treasuries from your leverage ratio calculations. Or he rolls back the Basel III endgame requirements entirely.
And what does that do?
Suddenly, Treasuries go from being a heavy regulatory burden to a free arbitrage opportunity. Banks can take customer deposits, which cost them very little, and buy Treasuries yielding 4.5% or 5% with zero regulatory penalty.
Wow. So he shifts the burden of holding all that U.S. debt from the Fed to the private sector. He turns the banking sector into a massive vacuum cleaner for U.S. debt.
Exactly. He privatizes the quantitative easing. Instead of the Fed printing money to buy bonds, the banks use their deposits to buy bonds, incentivized by regulatory relief. This allows Warsh to claim he shrunk the Fed's balance sheet while ensuring the bond market doesn't collapse.
And suddenly, the bank rally makes perfect sense. If I'm Jamie Dimon and the new Fed chair says, I'm going to cut your regulatory costs and let you load up on safe treasuries, I'm popping champagne.
You are absolutely popping champagne. That is why bank stocks were the clear winners in the Warsh shock. They become the engines of this new monetary regime. They become the new liquidity providers. They get profitable, safe yield handed to them on a silver platter.
But there's a huge risk here, right? We're talking about concentrating sovereign debt risk back into the banking system. Isn't that part of what caused issues in the past?
It is a massive risk.
I mean, if we load up the banks with treasuries, and then rates spike again for some reason, don't we get another Silicon Valley Bank situation, but on a systemic scale?
That is the bear case. You are essentially leveraging up the banking system again. You are linking the health of the banking sector directly to the price of U.S. government debt. If treasuries sell off, the banks take the hit.
So what's his thinking?
Warsh seems to believe that the private sector is better at pricing that risk than a central bureaucrat. It's a philosophical stance. Markets know best, not the Fed. And if the banks get in trouble, well, he probably assumes they're too big to fail anyway.
This brings us to the political side of things, because you can't just wave a wand to make this happen. There is a confirmation process, and it sounds like it's going to be an absolute nightmare.
Yeah.
We need to talk about the Senate, because none of these economic theories matter if Warsh can't get confirmed.
Nightmare is putting it mildly. The Senate is in gridlock. Republicans have a slim majority, 53 to 47, but it's not a done deal. And the reason isn't just Democrats, it's the internal war within the GOP.
And we have these investigations. We have to talk about the DOJ. This feels like a plot from a legal thriller.
This is the shadow hanging over the whole proceedings. The Department of Justice is actively investigating current Chair Powell and Governor Lisa Cook.
Investigating them for what?
The accusation is vaguely defined regulatory overreach. And there are whispers about re-examining old financial disclosures, insider trading allegations from years ago that were previously cleared.
Okay, but
the senators, specifically the Democrats, are calling them pretextual investigations. Meaning the accusation is that the Trump administration launched these investigations as a way to pressure Powell to resign, or to delegitimize him. It's an intimidation tactic.
That is incredibly heavy. The executive branch investigating the head of the independent central bank.
Yeah.
It challenges the entire separation of powers.
It's unprecedented in modern history. And it has caused a massive blockade in the Senate. Senator Tom Tillis, a Republican, has aligned with Elizabeth Warren, a Democrat.
Wow.
That is a unity ticket you almost never see.
When Tillis and Warren agree on something, you know it's serious. They're usually polar opposites.
Tillis is the linchpin here. He views the Fed's independence as sacrosanct. He sees this DOJ investigation not just as an attack on Powell the man, but as an assault on the institution of the Federal Reserve.
And what's he doing about it?
He has stated he will block any nominee until these sham investigations into Powell are closed.
So he's taking a principled stand against his own party's president.
He has drawn a line in the sand. He has said explicitly, I will not vote for Warsh. I will not vote for anyone until the DOJ backs off.
So you have a Republican senator effectively blocking a Republican president's nominee.
To protect the institution's independence, and with a 53-47 split, if Tillis defects, and he brings one or two other institutionalists like Susan Collins or Lisa Murkowski with him, Warsh doesn't have the votes.
So we are looking at a standoff. And the market hates uncertainty?
The market hates uncertainty more than anything. If this confirmation drags on into the spring, volatility is going to spike. We're looking at a potential delay in the Senate Banking Committee hearings. And remember, Powell's term ends in May. If Warsh isn't confirmed by then, or if Powell refuses to leave, we have a power vacuum.
That leads to a terrifying calendar date, May 2026. If Warsh is blocked and Powell's term expires, but he stays as governor, who is running the Fed?
That is the constitutional crisis scenario. You could have a zombie Fed, a board of governors with no confirmed chair operating under a cloud of DOJ investigations with the bond market vigilantes watching every single move.
Wow.
That is why the volatility index, the VIX, is starting to creep up. The market knows that even if Warsh is the perfect pick, the road to getting him in the seat is mined with explosives.
Let's pivot back to the market impact, specifically on the losers. We touched on silver crashing 30%. I want to go deeper there. Why silver? Why not gold? Gold was down 9%, which is bad, but silver got absolutely slaughtered.
Yeah, that's a great question. To understand the violence of that move, you have to understand who was owning silver and why. For the last 3 years, the dominant trade in commodities has been the debasement trade.
The debasement trade.
The thesis was simple. The U.S. government has $36 trillion in debt. Deficits are running at 7% of GDP. And the only mathematical way out is for the Fed to print money, cap yields, and inflate the debt away.
Right, financial repression. You buy hard assets because the dollar is guaranteed to lose value over time.
Exactly. And silver is the high beta version of that trade. It's the speculative, leverage-loving cousin of gold. If gold is a savings account against inflation, silver is a lottery ticket on hyperinflation.
It's more volatile.
It's a smaller market, it moves faster, and it's full of retail speculators and leveraged hedge funds.
But then Warsh steps in.
And Warsh is the anti-printer. He is explicitly saying, I will not monetize the debt, I will shrink the balance sheet. If you believe him, if you believe the Fed is actually going to stop expanding its balance sheet, the entire intellectual foundation for holding silver at $50 an ounce evaporates instantly.
It's a rug pull on the entire macro narrative.
It's a liquidation event. It wasn't just people selling, it was margin calls. It was hedge funds who were leveraged 5-to-1 on the end of the dollar thesis, suddenly realizing the guy in charge of the dollar wants to make it scarce again.
Wow.
When liquidity drains, the most speculative assets die first. Silver was a canary in the coal mine for a liquidity shock.
And the other loser, you mentioned the liquidity junkies in tech.
This is the same mechanism. Unprofitable tech, high leverage firms. Companies like Robinhood or AppLovin. These stocks rely on easy money and high retail engagement.
They need a market that is just awash in cash.
Exactly. If Warsh ends the Fed put and drains liquidity, the speculative froth comes right off the top. Warsh is focused on productive growth AI, real companies making real things that increase GDP per capita. He is not interested in monetary debasement, which just fuels speculation.
So it's a rotation from speculation to productivity, from growth at any cost to profitable growth.
That's the hope. That's the regime change. Whether he can pull it off without crashing the economy is the real question.
Because draining liquidity usually breaks something.
It always breaks something.
So what are the signposts we should be watching? If I'm a listener, what do I look at tomorrow morning to know if the Warsh thesis is playing out?
3 things. Okay.
Lay it on me.
1, the spread between the 2-year and the 10-year treasury. This is the yield curve. Warsh's policies suggest a steepener. 2-year yields go down because of cuts. 10-year yields go up because of balance sheet selling. If that spread widens, the market is buying the Warsh thesis.
Okay, the 2 men's spread. What's number 2?
2, watch the Senate Banking Committee schedule. Any delay in the Tillis blockade spikes volatility. If Tillis holds the line, this trade could reverse very, very quickly.
And 3.
3. Watch Jerome Powell. Does he signal he will stay on as a governor post-May? If he does, buy popcorn because the fireworks are just beginning.
It's going to be a wild spring. Okay, let's take a breath here. We've covered the news, the man, the philosophy, the politics, and the casualties. Now, let's get to the part everyone waits for. It's time for our This Is Not Financial Advice segment.
Right. And just to be clear, this is where we channel our inner hedge fund analyst pitching to the investment committee. We are going to pitch a trade that is outrageous, but plausible, high risk, high reward, and based entirely on this Warsh thesis.
And let me say it again.
And obviously, this is for entertainment purposes only. Do not trade your mortgage payment on this.
Please don't. I like having listeners who have homes. But if you were a daring trader, what's the play?
Okay, I'm calling this the regulatory arbitrage pair.
I like the sound of that. What are the legs?
So we are going long systemic importance and short the hedge.
Okay.
The long leg is leveraged long regional banks.
Regional banks, the ones that were basically collapsing a few years ago. You mean like KRE?
The very same. Here is the thesis. If Warsh executes privatized QE, regulatory capital requirements vanish. The banks are currently flush with deposits. If they are incentivized to buy treasuries and the regulations are cut.
They're essentially being given a license to print free money on the spread.
Exactly. They become the primary beneficiaries of the new regime. You want to own the plumbing that Warsh is trying to build. And regional banks have the most to gain from regulatory relief because the compliance costs hurt them the most.
Okay, so we're betting on the banks getting the sweetheart deal to save the bond market. I get it. What's the short leg?
The short leg is short silver.
Even after a 30% drop, you think there's more room to fall? That feels like chasing the trade.
I do. It's not just about the drop. It's about the philosophy. Silver is the highest beta play on loose money. The Warsh regime is explicitly about productive growth via AI, not monetary debasement.
Right.
If the balance sheet actually shrinks by trillions, the liquidity that props up speculative metals just evaporates.
Right.
The 30% drop is just the initial repricing. If he actually pulls this off, silver has a long, long way down to go. We could see silver back in the teens.
Wow. So long banks, short silver. You are betting on the banker taking over the Fed and absolutely crushing the inflation hedge.
Exactly. The catalyst is the confirmation hearings. As soon as Warsh explains his balance sheet normalization plan on C-SPAN, the metals capitulate and the banks rip.
And the risk, where does this all blow up in our faces?
The risk is one man, the Tillis block.
Right.
If the nomination fails, if Tillis blocks Warsh and Trump is forced to nominate a dove like Kevin Hassett instead, the trade blows up. Instantly, silver rips higher because the printing press is back on, yields crash, and the bank rally just fizzles because the regulatory relief vanishes.
So keep your eye on Senator Tom Tillis. He's the stop loss on this trade.
Precisely.
Incredible. Well, there you have it. Kevin Warsh is the nominee. The market is pricing in a liquidity drain, which is bad for gold and tech, and regulatory easing, which is great for banks. The confirmation, though, is a minefield due to the DOJ and Powell conflict.
And the final thought I'll leave you with is this. The Fed put, that idea that the central bank will always save you, is being replaced. We are moving from an era of liquidity at any cost to productivity or bust. It's a harder world, a more volatile world, but potentially a more honest one.
Keep your eyes on the yield curve and your hands on your wallet. This is Talk Tickers.
See you next time.
Disclaimer. The content of this podcast is for informational purposes only and does not constitute financial, legal, or investment advice. Market conditions change rapidly. Consult a professional before making any investment decisions.